Hi, this is Trevor, and today we're going to talk about risk and reward. Frequently, my students will ask me about risk or how risky a particular investment is and also how to evaluate risk. And the basic concept is the risk is the amount of variation. If you invested in a similar investment many different times, would you get the exact same performance and the exact same desired return every time, or would it be wildly variable? The more variable your potential results are, the more risk you're undertaking. Let's take a look at that graphically. The first thing is what we like to call the band of investments. And over here, if you have what is considered risk-free or very low risk, such as like treasury bills or other guaranteed investments, these are going to be considered low risk. And on the other end, you have high risk. In today's world, probably cryptocurrencies, junk bonds, those would be the highest type of risky investments where you don't really know what's going to happen. And somewhere in the middle, we have real estate. Now let's take a look at what risk looks like when it's quantified. Imagine this graph represents your target results. In other words, 0 would mean no variation from what you expected. It didn't perform more positively or more negatively than you expected. You got exactly the return that you wanted. Imagine you're investing in treasury bills. There's going to be no variation whatsoever. If you invested in T-bills 100 times, you would see no variation in your results. A higher risk investment, if you invested in that same thing multiple times, depending on when or how much, what time of the market you were getting into that investment, you may see extremely positive results. You may see results kind of around what you expected. You could end up seeing highly negative results. The point is that risk means a greater standard deviation in your potential results. The lower the standard deviation, or if there's no standard deviation, that would be risk-free. If there is wide standard deviation in your potential results, that would be high risk. Risk comes with a premium. So anytime you are looking at an investment and you are taking on more risk, then you should be taking on more reward. That's why you will see target returns for things like treasury bills, which have virtually no risk, will be very low. They won't have a premium attached to them. But real estate, maybe lower rated investments or other investments, those are going to be more risky, and therefore investors are going to demand that they get a premium or a higher reward for taking on that more risk. This concept holds true throughout the investment world. It's not just related to T-bills or real estate or others, but it works for stocks or development projects. Just know that risk and reward are correlated, and the higher the risk, the higher the return that an investor is going to require. This has been our quick overview on risk. I'm Trevor. Thanks for watching.